You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
All right, thanks to Citadel for hosting this panel. I'm going to start off by letting my fellow panelists introduce themselves.
Hi, everybody. I am Michael Palmer. I'm with Group 1 Trading. I've been at Group 1 Trading for about 16 years. Since 2007, I've been in the VIX options pit, where we've seen the VIX and volatility options in general, volatility trading, go from this very obscure little corner of the market nobody quite understood to really a market bellwether and kind of a critical piece of market infrastructure.
Hi, my name is Simon Ho. I've been an options industry trader for about 25 years. Me and my team were the ones who put together Spikes and proposed it in partnership with MIAX. So very excited to be here to talk about volatility.
My name is LT Tanzman. I'm the head of CES options routing at Citadel Securities. I've been there for about 8 years working in various parts of the options business, and I'm excited to be here as well.
Thanks, guys. So before we get started, just want to say we wanted to make this interactive, so if people have questions as we're talking, we'll try and field them. It's a little hard to see the audience with the lighting, but if people just raise their hands, we're happy to field and answer questions as we go through. So the first thing we want to talk about was really the history of volatility as an asset class, kind of how did we get here, and why has this product been successful? So first topic is really what made the initial launch of this product successful. Futures were launched before options, and they didn't really take off. Why did that happen, or why did the launch of options really blend and lead to kind of a successful launch of the product as a whole?
I guess I'll take that one. The VIX was around in the 90s and even in the early 2000s, and we would point to it as we talked about just general market volatility in the S&P 500. It was something that was looked at even before the futures were listed. The futures were listed 15 years ago in 2004. But you know, the CBOE is an options exchange, so people were very much interested in trading options. That's what really the focus was going to be on. So when they launched options in 2006, suddenly the futures became a critical sort of piece of that, and really built from there. More to the point, I think that the whole volatility kind of complex really benefited from timing. We launched options in 2006, we got used to what they were like, and then we had a big market sell-off in August of 2007. And that put a huge focus on what we did in volatility trading. People were really looking at it because we had a lot of market turmoil then. That obviously continued in 2008. We launched an ETF in 2009. So there was very much a beneficial timing of volatility trading being introduced and to it actually catching fire. It was sort of a lucky piece of history as far as the timing went.
I think to add to that, I mean, what has become folklore with regards to the VIX complex was the introduction of VXX, which was the first exchange-traded product. And I think that was seminal in terms of the growth of it, because it enabled retail investors to come into something that otherwise was really off limits to them. So, prior to that, for example, I was an FX options trader, and we could trade vol as an asset class, but it was a very complex thing, and it wasn't really available to the average person. You had to do rebalancing of your hedges and all that kind of stuff. With the advent of VXX, as a result of VIX futures, it really made it simplified and very accessible to retail people. And that's become folklore now. That's kind of the tail wagging the dog in terms of the volume growth from then on.
What would you guys say was more pivotal in terms of the kind of overall success of VIX as an asset class? We talked about VXX and the financial crisis. Was it more the financial crisis? Was it more VXX? Was it a combination of people realizing they needed coverage in this asset class as a result of the financial crisis and then the launching of VXX? If you guys could kind of talk through some of your thoughts around that.
I think that the ecosystem was very, very important. So having the options, the futures, and the ETF allows a lot of different participants with a lot of different strategies to get liquidity and stability and robustness in the product offering. And there's also an education component to it as well. There is, of course, path dependency through the crisis, but I think that people understanding the product, understanding how it can be used, what problems it can solve, and how it can fit into an overall portfolio was a really important piece, and that takes some time to build up.
I'd add to that I think timing, was critical. I mean, you mentioned 07 and 08. There's lots of turmoil in the market that we hadn't seen really in that order since 1987. So a lot of people really had abandoned lots of hedging, and this gave people a way to do a definitive hedge. It's negatively correlated to the underlying equity market. It has positive convexity, so it gives you high octane performance. All these things were appealing and new, and that was a function of the success.
Yeah, and appealing and new, I think, is big. It was interesting, right? We had a market where everything went down in 2008. We had one product that went up. People were very interested. What is this product that went up when everything else went down? And it became something that everybody could talk about. They could understand what the volatility of the market was, what the VIX was. So it just became interesting to start. It was also very well constructed. It made a lot of sense. That helped its longevity. But ultimately, I think initially, it was a very new, interesting idea that people really latched onto.
Okay, great. Kind of semi-related question. At the same time VIX was launched, there were products that were linked to other instruments launched that didn't really end up being as successful or end up succeeding. Could you guys give me some thoughts on why the S&P linked product was so much more successful than, for example, Russell and NASDAQ, which were both options on those were launched shortly after VIX launched? Why do we see huge growth in VIX linked to S&P and really kind of a dwindling or not a ton of interest or interaction in those other two products?
I'll take it. I think one of the first things was the idea of when the market has a big sell-off, we see a lot of correlation across products. That when the S&P 500 sells off, that volatility bleeds into every asset class. We see oil volatility. We see soybean volatility going up when the S&P 500 has a big drop down and the VIX spikes. So I think that when it comes to volatility exposure, a lot of it is covered by the VIX just because we see this correlation. And I think that's not limiting for the future. I think it's possible to have volatility indexes in a variety of areas, but at least initially, I think the correlation factor, the fact that volatility spikes everywhere when it spikes, was a big deal.
Yeah, I agree, and I think that the reason that S&P 500 in particular is the subject of most people's attention is because NASDAQ can have some peculiarities. It's very heavily weighted at the top, whereas S&P is sort of more broad-based. Then you've got something like Russell, where you have a lot of those constituents are highly illiquid. So I think there's a reason that people chose S&P, because of its flagship nature.
And having a critical mass of liquidity is also pretty important there, and that there is a lot of demand for that sort of exposure, but spread across a lot of products can be challenging to have transparency into the pricing you're going to get on that product.
So LT, it sounds like you're saying, for example, Russell 3000, there's just not enough liquidity in terms of either the underlying index or tying the underlying index liquidity to the components, and that structurally just makes it more difficult?
That makes it a lot more challenging just because you're not going to be able to quote that as tight in Russell by itself, let alone a second instrument there, especially when it's not necessarily in the time you need it as differentiated as a more liquid product that exists, and that's a challenge for that.
Yeah.
Okay, great, thanks guys. Next up, volatility-related ETFs. We talked about it, pretty critical to the growth of the asset class itself. I guess the first question I have around that is, as these products grew more complicated and kind of as we saw growth in the number of products that were linked to VIX, do you guys view that as a positive or negative in terms of the asset class as a whole?
I think the accessibility that those added to the market was really, really valuable, because then a lot of different people that couldn't put on those sorts of positions in the past now had easy liquid instruments that they could trade to get these exposures that 15 years earlier were only available to professionals that had highly specialized execution capabilities. So adding accessibility and transparency to these products really increased the market in which these could operate.
I also think, to take on from that point, is that the proliferation of ETPs was kind of inevitable given the success of the VIX futures and options subsequent to 07 and 08. So people were like, wow, this complex has got endless opportunity. We should now look at the sort of the tertiary products, which would be the ETPs. So I think it was bound to happen, and as a result, that probably bred some lackadaisical attitudes to sort of allow something like what happened with the XIV, for example. What has surprised me in the aftermath of that is that there hasn't really been any innovation to sort of replace what was potentially not the world's best product with something better.
Yeah, I think that VXX, the ETF that came out, it was really interesting because you can construct VXX using the front 2 months in the VIX futures. You can kind of synthetically construct it. So now you have this pair. You can quote VXX, the underlying, and the front 2 month futures in the VIX, and you can dynamically create an ETF using those futures. That created a little pairing. Now that said, VXX is a different product. It is a blend of the front 2 months, so it has a little bit of a different volatility than we saw in VIX options. It has a different settlement in the sense that the options settle the stock rather than cash. So while these things were all linked, they weren't perfectly one cohesive unit. And that actually, I think it was sort of one of those rising tides lifts all boats things, that the introduction of these products had helped them all grow because they were very, very related. They were very correlated. However, they're not exactly the same. They created different opportunities across different ETFs. And I would expand that to saying that UVXY, which at the time was a double-levered VXX, and SVXY, which is the inverse of VXX, further deepened the liquidity base that we saw in volatility markets.
And I think, Mike, part of what you're saying as well is, and for sure I think we saw it, was that there was definitely a lot of trading between, as the relationship between the products moved, we saw huge amounts of trading. So for example, trading on the close in futures in 2010, was probably one of the most liquid Vega markets in the entire world. And you're saying, I think, that was really tied to this role that was happening in VXX, and then that might also be tangentially related to people coming in and either hedging or wanting access to SVXY and UVXY as well.
Yeah, so I mean, in order to, if you have VIX futures, eventually they just settle to cash. So you couldn't create an ETF that just holds a singular month of VIX futures or anything. Someone has to sell one year long out, the 1 year long out and buy additional futures in a further out month, and that's how you sort of roll that exposure. I'm sure a lot of people know that. What that meant is at the end of the day, that people had to rebalance so they could come into the next day with the same exposure that they had on the previous day. That created a lot of trading in the futures and the close. That created a lot of opportunity for people who are involved in providing liquidity in all of those products. And especially in that time when the ETF was growing probably at a faster pace than the futures themselves in the VIX, it created a lot of sort of dislocations in that market, very short term, but a lot of opportunity in that sense.
So we talked a little bit about retail being the primary consumer/user of VXX. I guess I would pose the question to you guys: A, was that true, or is that a true statement? And then B, we talked a little bit about some of the other more complex is the wrong word, but some of the other products that are related. Is an SVXY a product that is primarily retail focused, or that retail is kind of the end consumer of? So if you guys could talk about kind of both, that would be.
So I think that when I look at VXX, one thing that makes it more accessible is the multi-list environment in which it operates. So you do have that product traded across 16 different exchanges now in a way that is a little bit cheaper for retail to trade in some of those cases. And it looks a lot more like other products versus the cash index products can be a little bit more complicated and require a little bit more expertise. So that makes it easier and cheaper for retail to get involved in the ETS in a more familiar environment. For a product that is pretty complicated, and making it easier to access is going to make it easier to trade.
So you can basically construct a kind of almost a buy and hold strategy using VXX, because you just buy VXX. But if you were trying to actually use VIX options or VIX futures, to Mike's point, you would have to constantly be rolling those, and that's not attractive to the end client, is what you're saying.
I mean, I would be careful about that, in that it's not necessarily designed as a buy and hold type of product in the ETF. They're a little bit different in that sense. But I more mean that you can trade it more like other stocks and ETFs in a way that trading a cash index isn't the exact same experience.
So my comment on this is that you talked initially about whether it really was driven by retail, and I think it's pretty difficult to know that. Certainly, that's the folklore that's come about. Everyone said, "Oh, we gave retail an opportunity," and the reason that was cited was because it's a bit more difficult to open a futures trading account than it is an options trading account, right? And so that became a good way, a conduit to funnel retail investors in. I have a feeling, though, that a lot of it would have been institutional type business as well, though.
Yeah, we saw institutional business in the VIX and then retail in VXX. Just like in the S&P 500, we saw institutional, and in the spiders, the SPY product, we saw a lot of retail. They wind up being sort of complementary in that sense that you can bring in a lot of customers with different products. I think that your point about it not being a cash settled index is very, very kind of makes a lot more sense to the retail customer. But ultimately, these are products that do a little bit different things, and they attract different people despite being very related.
Okay, great. Next question. How did the events of February 5th kind of shape the asset class? And when I say asset class, I mean the linked note structure moving forward. Open-ended, but.
I think that it was a very educational moment in terms of what some of the risks are that are inherent in these products. While they do look like other products, as I was saying before, there are some things that are very, very different about them, and products that are tied to one-day returns can behave strangely on very, very volatile days. So it's important to understand the risks that are inherent in those products and that they are margined and designed appropriately for that, but also with enough education and transparency about how they might actually behave in stress scenarios that don't really happen that often. You need to be very mindful of what the exposures and blind spots are of these products when you're thinking about them in the context of your holdings.
Well, I would add to that something like XIV, its demise was inevitable, and it will be repeated again at some point. As long as the VIX goes up high enough, that thing's going to lose all of its money. So I think actually this is a key moment for our industry to potentially come up with a Mark II version which doesn't allow for that kind of thing. Now, that's pretty easy to do. We trade options after all. It's the most sort of flexible tool on the planet in terms of shaping distributions. So it certainly can be done. Whether or not people want to buy and sell those products is another matter, but I'm surprised that nothing has happened as yet on the issuing side to try to cater for that.
I think it's worth remembering sort of what really happened. We saw that the S&P 500 was down about 100 at 3 p.m. on February 5th, and it was down about 150 at 3:15. There was a huge run on futures and the VIX futures as people were trying to rebalance and a variety of other strategies. So there was a little bit of a liquidity hole there that sent SVXY, to remind what it is, the inverse of VXX. That's what sent it lower so fast and surprised people by how much it could move in that period. I think one of the remarkable things to me is how fast the market sort of rebounded from that. We saw markets tighten up and liquidity be there in size on February 6th, 7th. So while we saw the demise of XIV, with SVXY, about a month later, 6 weeks later, they delevered it. It now moves at negative 0.5 of what VXX does. So whereas it used to be that we'd need VIX to essentially double to send that ETF to zero, now it's got to go from like 15 to 45 or higher to send that product lower. This was always a risk that we knew existed. To your point, this was not like a situation that was like totally blindsided the industry. I think it did blindside certain parts. But this was baked in, that traders and a lot of people involved with this were aware that this was a potentiality that should eventually happen, and February 5th was the day. So it was an interesting day, though. I mean, just to go on it, it was amazing how much talk went in it, and when it finally happened, it was sort of how surprised you were by the moment. That we had a big sell-off during the day there, but we had seen a little bit of that up to that period. That market sell-off we saw wasn't totally out of nowhere. What was interesting about it is sort of what the timing of it and what went on there. We'd probably do things different the second time around had we got another look at it. There's no education in the second kick of a mule. But I think that it was interesting to see it. I think the delevering of UVXY to 1.5 of VXX and then the delevering of SVXY, I think that took a lot of that run on VIX futures on the close. I think that took it out of the market. If we were to see this again, I think it'd be very, very hard for it to happen again in the same way. But it was certainly an interesting day for the market.
And we talked about it earlier, but it seemed pretty clear, I think, to me that because of the kind of massive amount of intercorrelation between the products, that was really what led to this, accelerated sell-off into the kind of closing of the futures at 315. Right? I mean, the market closed down to your point, and then really you could kind of see things start accelerating and, futures offers start disappearing and, E-mini bids disappearing, and that combination of those things, it makes for great trading a lot of the time. In this particular instance, it definitely seemed like it.
The market
definitely seemed like it worked against XIV for sure.
The market was demanding liquidity when it was most ill-equipped to provide it, right at the very end of the day there. So.
Combined with that, of course, is that those things have inherent negative gamma. So you've got to keep buying the futures, and that exacerbated it because you're close to the end of the day, and so then you're getting close to the 80% level where they had to unwind the thing. So, in fact,
important point.
When my colleague and I walked in the door that subsequent morning, so the end of your afternoon, the market had closed. It just kept, the VIX futures the index especially kept going up because there's no way out. That someone needed to buy more stuff, but we know who, but you weren't able to access it essentially.
Yeah. Okay. So one of the other topics was really the expansion of volatility as an asset class. So we've talked a little bit about why S&P has been successful versus other U.S.-based futures. We've looked at volatility on other asset classes, and we've also looked at volatility in other geographies. Can you guys talk about kind of what do you think it's going to take to have a success in a VIX-related product in either a different geography or a different asset class, or will we ever see that? Is there demand out there for classes outside of the S&P 500 to be linked to a volatility product?
I think the international interest in the product, I think, is really, really a big potential growth area for the industry. And there's two big things that would need to be addressed to get that to happen. So when I think about Europe, for instance, the lack of central clearing and with the markets being very fractured makes a general market structure issue for amassing good liquidity. And two, that exposure is available in the U.S. in a fairly liquid product. So European investors have to overcome their local market structure, and they have to choose over an already liquid market. But I think that if you were to get a more cohesive market structure, and more of a kind of multi-list competitive environment in Europe, then that could actually grow a lot of interest there, where there are a lot of people that are trying to get exposure to the same sort of asset class that would have many reasons to want to trade it locally instead of having to ship their interest over to the U.S. markets.
So I agree with that synopsis in general. I think that a caveat I have is that one, for a volatility index to really work, you need to have a super liquid underlying options market, and that's just not available anywhere. Not everywhere, I mean. So even if you look at the commodity complex, if you look in there, frankly, the only one that you could really possibly say hand on heart would be a goer for that would be oil. So that's it. But even that pales into insignificance relative to the depth of S&P 500 options, for example. So I think that's one major challenge, is to try and find something that's going to give you hedgeable opportunities. But also, to your point about the European side of things, a lot of people, at least what I've heard, is the people from Europe will eschew trading, say, the V stocks, for example, in preference for trading VIX, because one of the things you mentioned is in times of market stress, correlations of indices, but volatility indices in particular, approach 1. So you may as well have the VIX where you've got the liquidity where you can get in and out of it, rather than stick with the home-based ones, even though they may have more sort of direct correlation to you.
Okay. So the next question is really, even within the S&P linked space, MIAX has just launched spikes. Everybody talk a little bit about, what it's going to take for that product to be successful and really differentials between VIX and spikes.
It's you.
That's me, right? So, well, I'm glad you asked that question, but you didn't ask it how I wanted you to ask it.
Sorry.
No, so I've been charged with sort of delivering some breaking news, and that is that MIAX Exchange Group has signed a partnership with the MGEX, the Minneapolis Futures Exchange, to list spike options, and they will be launched subject to CFTC approval. Did I answer your question?
Spike futures.
Spike futures.
Yeah.
Spikes futures.
And I guess for everybody, really, is there room for another S&P linked volatility product? Is the launch of spikes going to grow the pie as a whole, or is it just going to move liquidity from SIBO to MIAX?
So I think that bringing competition to the industry is always really, really good for everybody. I don't see it necessarily taking away any of the existing exposure or shrinking the market, I guess. I see it as something that's strictly going to grow the market overall. As you bring competition, you bring more accessibility to this asset class space. And that's pretty exciting to see innovation in the space and see what are some of the other ways that we can provide this entire market with this sort of exposure.
Yeah, I would say that anytime you have a industry that has sort of got an innovative new thing, that's a sign that it's a healthy and growing industry. Nobody is making bigger, faster, smarter buggy whips. People are thinking about volatility space. It's growing. Where can we add? And the spikes is along that line, as an innovation along that line. And while it's been modest growth so far, I would say that the liquidity is there, that if you wanted to do 10,000 call spreads in the VIX, or vol spreads in the spikes, you could get that liquidity. We have it priced out. We would be able to do it. So the potential for it to become a big player in the volatility market remains there. And I just think in general that it's great that we see people bringing in new entrants like this in the marketplace. It means that it's a healthy, growing space, and the spikes is definitely an innovation along those lines.
Great. So kind of along the same lines, do you guys think it will, I think my read on your answer to the, why aren't there other geographies or other asset classes was kind of, it doesn't really make a ton of sense, or we don't really have the liquidity in the underlying. Is there something out there that could create demand or could help grow a kind of a new entrant in volatility as an asset class? So for example, could another financial crisis lead to, interest rate related VIX, becoming tradable or more tradable? Or do we need another financial crisis to really build out, a different geography? Or would that even matter?
It would take a very unique set of circumstances to grow something like that. If you had if you had volatility of the dollar, let's say, the volatility of the dollar is something like 2%. Like if it explodes, it goes to 4%. It's really hard to get excited about that. And so you would need whatever caused the crisis to be sort of the perfect storm and have a volatility product based on that you could trade, that would then also have to stay volatile once things calm down a little bit. The interesting thing about the S&P 500, it's trading at that sort of perfect handle. The volatility of the S&P 500 generally equates to where the VIX is. And $15 to $20 to $25, that's a very tradable product. You can kind of move around those prices, and that makes a lot of sense for a lot of people who want to get involved in that. So I think I certainly think the potential is there. And we saw, you probably remember this, we had an oil VIX in the SIBO. We had a Brazil VIX. Around the Brazil election, I remember the Brazil VIX was up like 15 points over the regular VIX. So there are opportunities out there where people do get interested in this stuff. It's just, it hasn't been sustained, and it hasn't sort of been consistent in any way that makes it sort of a long-standing product.
So my take on that is, I broadly agree. I think that, however, there are few opportunities where it would be successful. As we talked about earlier, even something like oil, it's a big market for sure, and relative to commodities, it's the king. But as I said, it pales into comparison to the S&P 500. So I think you have to really choose the products very carefully, because you need something that is going to exhibit significant volatility, because that's what attracts people to it. Or the corollary is it's not necessarily that volatile, but it is so structurally important to people that they have to trade it.
Yep.
I think also having like low cost to trade and accessibility, and a good knowledge that you will have liquidity when you need to round turn your position is very, very important. So if you try to, if the product is very liquid and you can't hedge different exposures, that's going to be very challenging for it. But if you are trading on something where you can actually hedge a lot of the other risks, then that is a very healthy structure on which to build the product.
Great, thanks guys. So we've had a lot of conversation about kind of retail versus institutional. Can you guys give me your viewpoint really on who the end client is, or whether there's a specific end client who should be using VIX? Is it great for everybody? We've talked a little bit about, VXX might be more for retail, VIX might be more for institutional. At the same time, I would argue we've seen a lot of kind of bleed over, between the two, and VIX options or VIX futures have been, attractive to more retail-based customers. So is there kind of a core use case or core consumer of the product where it makes the most sense? Is it great for everybody? Are there certain segments that are better for others, worse for others? If you guys could opine on that, that would be.
I think one thing that the industry has done well here is that there is a big picture question of how do we give people volatility exposure. And then we've taken that, we've right-sized different solutions for it, because we don't want to just have a single product, single solution that tries to serve every single customer, institutional or retail out there. Being able to tailor different solutions to different users who have different needs and how they trade it is actually something that the industry has done well in terms of innovation and product launch, to be able to right-size the solutions for the different constituents who will want to trade it.
Yeah, I think what's interesting about the VIX is it works for a wide variety of customers. That you have people who want to hedge a giant portfolio and they might buy VIX options. You could have somebody else out there who wants to create yield using VIX products. They maybe buy the second month and sell the front month future. You have a variety of other strategies people could do because they think the volatility of volatility is too high, too low, you name it. You can enter a nearly uncountable number of strategies using these products. You have a lot of interesting things about them that drive a lot of people to these products. First and foremost is that the VIX itself is a very high vol product. And it's a sustained high vol. It's usually something like a 90 volatility in the front month. That creates a lot of yield if you were short options. That it has a very much an explosive element. It could go from 15 to 40 overnight. And all those factors involved create a lot of interesting strategies for a variety of customers to access. So there isn't sort of one strategy that you can sell, but I think if you really get people to dive into the whole product, they'll find something that is interesting for them, what they want to do, what they want to hedge, what they really want to kind of grow into.
Do you guys think, again, this is maybe an unfair question, but do you guys think levered volatility-linked products are appropriate for retail customers? And appropriate's maybe the wrong word, but is that, XIV is a good example, I think, of, it's unclear to me that everybody who was trading that product understood the potential for it to, to go to zero. And, are there things that should be implemented? I know Simon talked earlier about, there are ways to structure the product so they can't explode, and some other changes have been made, but, is that a good product for a retail investor to be trading? Is that something that should be traded more through a managed fund, or more on an institutional basis, or everybody should have access to everything? And
I think I won't give a suitability recommendation. This is my own opinion on this topic, but I think there are two aspects of this. One is, what is the product and how does it behave? And two is, what is the market around that? What are the costs to trade it? What is the liquidity, how is that going to behave in times of stress? And one thing that's really important for us is that for all the products, the liquidity and the transparency and the pricing is there, and you get good access to trade when you need it. And that's very, very important, and to some extent separate from what is the product itself designed to do. And so that's one thing that we want to make sure that no matter what the product, there is good access to liquidity for all participants.
I think it should be noted that these were extraordinarily popular products to trade. VXX is routinely in the top 5 of all stocks traded in any given day. These are explosive products. SVXY, obviously had a major sell-off. XIV, which was DTN, obviously did as well. I do think that, between detonations, these things are irresistible to retail investors. That said, the tools exist, and for people to sort of trade against them, they had puts. You could have bought on the SP 500. You could have done on the SVXY. And you get a number of things to hedge it. It was a very broad ecosystem. There are people that got caught up in it in the wrong way, but not everybody. The market recovered pretty simply. And I think that in general, sort of kind of tasking regulators with the idea of like, hey, figure out what the next problem is and remove it ahead of time is kind of a tough errand. And generally speaking, I think these products have been pretty stable. They are extraordinarily popular. There's a lot of people that trade the options, trade the stocks themselves. And I think it's sort of healthy that they're out there. They grow volatility, liquidity in the volatility space as a whole. And frankly, I would almost go the other way around. We delevered UVXY from two times VXX to 1.5. I think the opportunity exists to reintroduce a 2 times volatility one. It would be super popular. It would raise liquidity in the space. And people are understanding more and more about these products that I think it could make sense for these to exist.
I agree with that, but I also think that you'd find a tougher go of it with the regulators, given what has happened, and their sensitivity to.
And that's why they delevered it, and that makes sense.
Yeah,
right.
So I think that would be a challenge. Look, I think it's a philosophical question because one, do you just deny access to people? In which case, are you denying it to a specific cohort? Is it some sort of apartheid going on there or not? I mean, if these things are available for trading, then it's pretty hard to deny a particular cohort from using it. Mm-hmm. So it's up to the registered advisors to advise their clients appropriately. I mean, otherwise you just don't make it available.
Yeah.
All right, great. Let's go to the audience and see if we have any questions in the audience. There's one in the back.
Thank you very much. I had a question around the ecosystem around the volatility products you were talking about. And do you think it might be possible from a structural perspective to consider maybe moving the close of the VIX futures, having the NAV methodology of the ETPs, or potentially changing around the structure of the products to protect them better against some of the 3 to 315 illiquidity moves that you had referenced?
I guess I'll take it. So for the, just for clarification, so the question he's asking is right now the basically the VXX and these things, they have to rebalance on the 315 close in VIX futures. The idea there being that the market's actually closed for the most part with stocks and a variety of other products at 3 o'clock. I'm speaking in Chicago time. The idea would be, hey, let's move, instead of 315 settle for these products, let's move it to 3 o'clock because that's theoretically a more liquid time for the market. One, I think that you're always going to have a run on liquidity on the close. You could set it to any particular time frame. You could set it to 3:15, 3:10, 3 o'clock. There's always going to be a huge run on the liquidity for somebody who needs to rebalance a big exposure. I think it might make some difference making it 3 o'clock. I don't think it's going to make a massive difference, and it would be virtually unnoticeable. The second half that would actually make it a little tough to do it that way is that you would pretty much have to close the products at 3 o'clock then too. Because if you're going to say the day ends at 3 o'clock, but these continue to trade for 3:15, they have an entirely different exposure for those last 15 minutes, especially if we made a big move. That you would say, well, I don't understand, VXX was up 10%, shouldn't UVXY have been up 15? You say, well, we can say that now, but if we move that time to 3 o'clock and they still trade to 3:15, we could say, no, that's up 10, but this one's up 17. Or this one's up 13. So it starts getting a little tricky to build that.
I think it would, sorry to interrupt,
Yeah.
I think it would also be incredibly difficult to actually get that through in terms of the number of exchanges you would need to coordinate across CME, CBOE, CFE, and I think you would run into people who would then throw up their hands and say, well, wait a second, the reason we're closing the indexes 15 minutes after the cash closes is because we want to actually rebalance some of our cash positions around the index position. So I think if you said, well, we should close the VIX futures earlier or close those in simultaneously to the cash, I think you're going to get arguments around needing to have the futures, the S&P futures open longer. And again, if the S&P futures are open longer, why wouldn't the VIX futures be open as well?
I mean, a lot of the participants in that settlement are fairly sophisticated, and so they all know what time things close, and so they can plan appropriately for that. None of them are caught off guard by the fact that it's 3:15 right now, and so if you just move it, the participants won't change that much, essentially.
Right, and the CBOE listed what's known as the TAS product, the Trade at Settlement product. This means that you could trade a VIX future and it will settle on the closing price, depending on the price you trade it, but on the closing price at 315. So you could trade it at 230 and you could guarantee a fill at 315 of a certain price. And that was to address this run on liquidity at the end of the day. I think it also should be noted that with delevering UVXY and SVXY, that some of the exposure is taken out. Not a huge amount, because VXX is still the biggest product of the whole bunch, and that hasn't changed at all. But some of that run on liquidity has been taken out on the close, and I also think it's notable that a lot more people prepared for this situation, especially since February 5th of last year. I think it is an interesting idea. I certainly understand the idea behind it. I think that it was an issue running, the futures, the S&P 500 selling off between 3 and 315 that day was a big issue for liquidity. I don't think moving from 3 to 15 back to 3 really is going to change the math all that much. There was going to be a big run on liquidity no matter what.
Other questions? All right, that looks like it. Thank you, everybody.
Thank you.
Thanks, guys.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.